quiz.
You can take a quiz after this thing.
We are not going to issue a quiz.
Maybe we should.
We're not going
People
to issue
People need to be tested on their
Look
knowledge.
at me. We are not going to issue a quiz.
Hello, everybody, and welcome back to the Fun Money Podcast. We are your hosts. I am Josh Hargrove.
And I am Ross Powell.
Maybe we have this video thing figured out now.
We're getting there.
Yeah,
we're getting a little more comfortable.
Ross is there.
Josh is.
The people are
look
there.
Look at the camera. Look at Josh, and it's pretty similar. Yeah, we're getting there.
And I don't know if you notice anything different about us, but we're not wearing headphones.
It's a little odd.
It is. It actually does feel weird.
It wouldn't work without Avi.
This is true. This
Off
is true.
camera.
Yeah, we've got our production manager over there.
That's right.
Sound engineer extraordinaire. Hey,
right.
So we've got a great topic today. We're talking about bonds.
Yes, we're going to talk about bonds.
Yeah, we're going to talk about bonds. Now, bonds is I think it's one of those investment topics that if you were to kind of poll people or just have a conversation with people and say, hey,
What is a bond?
You've heard of bonds, right? Oh, yeah, I've heard of bonds. Are you invested in bonds? Oh, yeah, I think that there's some bonds in my 401k or something.
Part of my portfolio.
What's a bond?
I don't know.
I don't know.
It's pretty common.
Yeah.
Or
maybe you could give some sort of explanation.
Yeah.
Maybe you can say it's a it's a debt of some sort.
Yeah, it's
I don't know.
Less risky usually, or they compare it to either they go straight to treasury bonds, or they talk about savings bonds.
Yeah. Yeah,
educational savings bonds.
Like we were talking about earlier, when was the last time you
used Sigma?
Used Sigma. It's like
it's been a long time.
20 years ago in math. So for a lot of people, same kind of thing with bonds. And so we are going to talk today about bonds. Now, specifically, this is a timely conversation because of what has been going on in the bond market. And so if you're listening and you have money invested, you've seen your investment value drop. And we understand
depending on when you started looking at it, what your comparison period
sure.
is.
But we know the stock market fluctuates, and most people expect that. And so they expect to see some downward movement there. But then when you take a look at your bonds, those are down.
Yeah.
And probably thinking, what the heck? I thought this was supposed to be the safe thing, right? That's what my finance teacher told me back in my sophomore year.
Yeah, and kind of continuing our conversation from earlier, when someone knows something about bonds, they'll know in general that they're a less volatile investment and that they hold their value and that they throw off some interest.
Yeah. Okay, so where do we start on a conversation about bonds so that we don't bore people? Because this is the Fun Money Podcast.
That's right, the Fun Money Podcast. And we're going to keep it,
we
relatively short, and then we're going to talk about, we got a snippet lined up. So
what are they, and why are yours down? What's the deal?
Yeah, so I think we should define what they are. We should talk about how they're priced and how that changes, how that affects the value of the business, and it may adjust your strategy with bonds.
Yeah.
And then talk about some of the components that affect that pricing.
Okay. That sounds great, man.
And then wrap it up from there. So
you have fun. I'm gonna hop on Wordle real quick while you knock out this episode.
You're just gonna. You check all the way out. So
you got this. No.
Okay. So Josh, what is a bond?
Okay. So let's say I own a company, and
you own a company.
I own a company, and I do own a company. But let's say I own a company, and I'm going. I need more money. I need more capital.
Okay.
Because I want to expand. I want to, fill in the blank. Any number of reasons why companies, need more money, right?
Okay.
So there are some ways that you can go about raising funds. And one of those ways is that you can sell bonds. You basically can say, hey, people, loan us money. We will pay you interest, and then we will return your money. That's basically what a bond is.
Yeah.
Okay.
I like to use the example of AT&T. So AT&T is so large, they're not going to just go to a bank and borrow $100 million.
Yep.
They're going to source it out to the market, to the bond market. So they're going to create each of these bonds that are, in $1,000 instruments, usually sold in bundles of 10 or more.
Mm-hmm.
Source those bonds and they sell them at, like you said, given interest rate, and then they pay off that interest rate and then have a return of principal at the end. There are several different styles of bonds and options, but in general, that's how they work.
Municipalities do the same thing. Government, the federal government, your local government, international governments, they sell bonds. So you'll see bond packages go to a vote for the people, and that's basically what they're doing. They're going, hey, we want to raise money by selling bonds. Can we do that?
Yeah.
So that is what a bond. That's what bonds are.
Yeah.
A very simple
way. So
yeah.
it's either a municipality or a corporation.
Yeah.
Loaning money, borrowing money from the public.
Okay. So now so that's what a bond is. Why are people invested in bonds?
Why are people invested in bonds? Because in general, bonds have a fixed value, a par value, that is returned at the end of the maturation of the bond, and it throws off stable interest payments. And so, like we said earlier, the bond market is significantly less volatile than the stock market. And so if you're looking for some portfolio balance, this can be a way to get, in general, a way to get some security and level amounts of regular payments. You know what those fixed payments are going to be and when they're coming.
And let's put this in a very personal, let's kind of personalize this a little bit. So those of you who are listening, imagine you have a house payment and you have a car payment, and you're wanting to take a big family vacation coming up later this year that's going to cost $10,000, and you lose your job. Are you going to go on that vacation? I mean, you might, but you're going to make sure that your house payment is paid and your car payment is paid and your bills are paid. So corporations and municipalities do the same thing. The bond payment is priority because why? They don't want to default. Why? Because they don't want that to affect their credit score. So the next time they want to go borrow money, they want to know that they can do it. And so that's why bonds are safer. Also, they have a credit score, basically,
yes,
just like you've got
credit score.
Right. You've got a 700, 750, 800 credit score or whatever. Corporations are rated by credit rating agencies, Standard & Poor's, Moody's, Fitch, AM Best does insurance, but Standard & Poor's, Moody's, and Fitch, I think, are the three biggest ones. And they put out their credit ratings, and they basically say, here's how trustworthy this company is to be able to get a loan, issue a bond.
That's right, Josh. And just like your personal credit score affects the interest that you owe to your mortgage company or your auto lender or on your credit card, this corporate bond score is going to affect the interest that's owed on the bonds that are issued.
Yeah.
So why are bonds down recently?
Why are bonds down?
Why are they not holding their value?
Okay, so let's say that you own a bond.
I own a bond.
And your bond pays a 5% coupon. In other words, it's the interest payment is 5%. Okay, and then new bonds. Okay, so you've got your bond.
I got my bond.
Paying 5%, and you think, you know what? I kind of want to be done with this. I want to go ahead and sell it. I want to use the cash to do something else.
Okay.
Use it for whatever you want, but you want to sell the bond, use the cash for something else.
Okay.
You paid $1,000 to buy the bond originally. So you think, all right, well, I'll just get $1,000 from someone else and they just take over basically, right? Well, what if new bonds being issued are paying 6%, and now let's say I'm in the market to buy a bond.
Okay.
I can buy yours for $1,000 and yours pays 5%, or I can buy I can buy a new one for $1,000 and it pays 6%. Why would I give you $1,000 for 5% when the new one pays 6%?
That's exactly right. So my old bond at the old interest rate in an increasing interest rate environment is now worth
less. Conversely, let's say that yours is paying 5%, new ones are only paying 4%. Now I'm like, all right, I might be willing to pay a little bit more for yours because I know I'm going to get a higher interest out of that, a higher coupon out of that bond.
Yeah.
So that's
also
interest rates affect pricing. That's how interest rates affect pricing.
Interest rates affect pricing, but this is assuming that my bond was at the same rating of the new bond that you're evaluating, and also that they have the same relative date to maturation and
Yeah.
duration, and all
Yeah.
kinds of other factors that play into the pricing of the
Right.
bonds.
So the Fed has raised interest rates so far twice this year. There was one raise, I believe, last year before the end of the year, and so as interest rates have risen, what that has caused is that new bonds, existing bond pricing gets compressed
Yeah,
as a result.
just like the initial
Yeah.
example that you gave.
Yeah. So what does that mean? Okay. So let's go back to that example though, where you have a bond and you're wanting to
I have
sell
a bond.
it. Okay. So and you go, well, interest rates are up, so therefore if I try to sell it, I'm going to take a loss on this. Well, you don't have to sell it, right? You can
don't.
hold on to the thing, keep on getting 5%.
As long as I don't need the cash for it, then I
Right.
can continue to hold it.
Yeah, you hold it, and because what will eventually happen is what? Once it gets, let's say it's a 10-year bond, and you hold it the entire 10 years, what is the company going to do?
At the end of that 10 years, they're going to pay me that full $1,000.
You're going to get the $1,000
and
back.
all between then, they're going to pay me that same 5%
Exactly.
that the bond is.
Yeah. So that pricing fluctuation becomes an issue if you are wanting to or needing to sell your bond anytime before it matures. Okay. So all right. So now what does somebody do with that information? So knowing that, all right, let's say somebody listening here, they have their 401k and they've seen, all right, my bond allocation has gone down in value. How should that person respond in light of what we just said?
Assuming they don't have some out of order portfolio allocation that needs to be adjusted, then this would be something that would correct itself if they own individual bonds as those individual bonds get closer to that.
Yeah, that's right. So yeah, essentially it's like, okay, they're going
to
come
fully
back,
recover.
you get the 1,000, right?
Unless, of course, one of those companies goes and defaults on those bonds. That's the risk that we didn't talk about yet.
So. Right. So don't gloss over that too. Okay, you got to unpack that a little bit for the people.
Okay, yeah. So default, just like in the personal world, is where the corporations don't pay the debts that they owe, or they don't pay their interests on time.
Yeah.
And then they have a default event, and sometimes it's bankruptcy where they've gone all the way out of business, and sometimes it's just timing of the payment, and sometimes it's a signal that there's something going on. So not all default events are created equal.
Right.
But depending on the score that you've got, that helps you, based on those rating agencies, determine the likelihood of one of those default events occurring.
Yeah. Now, most people don't, at least in my experience, most people don't hold individual bonds. Most people hold mutual funds that are invested in individual bonds, just like most people have mutual funds invested in individual stocks.
Yeah.
While they may have a few stocks that they've selected specifically, generally mutual funds are by far and away the most common way that people have their money invested in things like a 401k IRA or just regular investment. So one thing to keep in mind is, just notwithstanding what we just said about bonds, you have to realize that when you have money invested in a mutual fund that is invested in bonds, that fund manager is going to make moves. And so he or she may be buying and selling bonds, and you might be losing out. I mean, if they sell bond holdings inside of that fund, then you're missing out. You know, like you don't have any control over that, I guess is what I'm saying.
Right.
So you got to keep that in mind. What we said in principle still does hold true. It's just that you don't have any direct control over whether the bonds held in that mutual fund are going to be bought or sold.
Or held to maturity, or when that transaction
Yeah.
happens, because you own just that fund. And it muddies the water around the conversation around when the investment is going to return to its par value, because it's not one particular asset, it's a conglomeration of lots and lots of assets.
Yeah.
So,
but still, on principle, I think it's safe to say that the approach to the bond mutual funds that you have should probably be the same. I should probably not word that the way that I did because that comes across as a recommendation, and we all know how dangerous it is for investment professionals to say
to make
things
a
like
blanket
that.
recommendation without the evaluation and analysis.
But kind of the general rule of thumb is that same thing applies with that bond mutual fund, is that the pricing will normalize the closer these bonds get to their maturation dates. It's just more that you have less control over transactions that are happening in between. So the takeaway there is, like in most cases, if you have an investment strategy, you should expect some movement. This is definitely out of the ordinary, bigger movement than we typically see with bonds.
Yes.
But it isn't unheard of. Yes. And as bonds hit that maturity rate, as long as companies aren't defaulting, you're still going to get the interest that you expected.
I think this has been a pretty good review, an introduction to bonds.
You can take a quiz after this thing.
We are not going to issue a quiz.
Maybe we should.
We're not going
to
issue
People need to be tested on their
Look
knowledge.
at me. We are not going to issue a quiz.
Okay,
There's
fine.
no CPE credits for listening to the Fun Money Podcast. Just fun credits.
Just fun credits. That's right. Fun life credits. So, okay.
Quick review.
Quick review. Bonds are debt instruments issued by corporations
Loans.
And municipalities.
Yes.
And you can purchase those. They pay a stated interest rate that you can count on unless that company or municipality defaults. That's one risk. The other risk is that interest rates will move. That will affect the price of your bond. And we didn't get into something called duration. That's a very complicated topic, but just know that some bond prices will move in greater measure than other bonds based on what happens with interest rates.
And there's like six different
types of
variables that factor into how effective that interest rate changes to the bond pricing of that particular bond.
Yeah. But know your strategy. Don't freak out. Stick with your strategy. And you always want to be careful not to sell low if you can avoid it. And that's certainly the case right now in the bond world.
Yes.
All right.
So what have you been listening to this week, Josh?
I've been listening to some 80s music.
80s
inspired
music.
by Stranger Things Season 4.
Okay.
Yep.
I have not started it yet.
We started watching it. And, of course, if you're familiar with the show, it's set in the 80s. Our time frame, right? When we, our first foray into music was that 80s stuff. So it's kind of cool just hearing, seeing the themes, seeing the clothes, hearing the music. But it's also been fun. My kids, my older kids, anyways, not my younger ones, but my older kids are watching it with us. And, so they hear a song like, oh man, then the next thing I know, I hear it emanating from their bedroom as they're replaying the song. So that's been fun. We just got some 80s jams.
Yeah, it's a little music
on
education for your kids.
Yeah, exactly. So all in on the 80s stuff. It's been fun. How about you, Ross?
Okay, so summer is here, and I have a jam that I listen to every summer.
Alice Cooper.
No, not
Beach
School's
Boys.
Out for the Summer.
Beach Boys.
No. Those are later in the summer when you're actually going to the beach or the day that school gets out. But,
Jimmy Buffett.
No, it's Will Smith and DJ Jazzy Jeff. Summertime. Summertime.
Yeah.
All right.
Yeah. Wait, I thought that was Sublime.
There's probably a Sublime.
They have a song called Summertime.
I'm not thinking.
Anyways. Yeah, you know it now.
No.
There you go.
It's probably way back in the. But anyway, Summertime. The Fresh Prince and DJ Jazzy Jeff.
Sweet.
On my playlist every June.
So Ross and I are always working on topics. Obviously, what are we gonna talk about on this podcast? And as we watch listenership grow, we've kind of had this idea of what do the people want? What do you want to hear? So we would love to get your ideas. You can email ross.powell@insightwp.com or josh.hargrove@insightwp.com. Is there an easier way to do this? thefunmoneypodcast.com. There's a link there where you can contact us one way or another. Reach out to us with your topics. We'd love for you to pose questions to us. Questions to us that we can take some time, work through, and make a podcast topic.
Yeah, we'd love to hear your questions. We'd love to get you engaged and see what we can do to help you think about some of these things in a new, fun way.
Yeah, yeah. But nothing like, why is Ross so much cooler than Josh? We don't.
Those are the questions I'm sending in from an alternative email address.
All right. Don't let bonds keep you in bondage. You too can be a financial success story.
Oh. All right. We'll
This
catch
has
you
been
next time
fun.
on the Fun Money Podcast.
See ya.